This is the Value Investor Podcast with Tracey Reineck. All things value, all the time.
Welcome back, value investors. So we had another Berkshire Hathaway annual meeting. Did you watch it? I recorded it because I was out and about and on the road on that Saturday. So I knew I couldn't watch the entire thing. So I recorded it. And yes, I spent 7 hours watching all of the question and answers, all the interviews. They did break for lunch, but CNBC had some pre-recorded interviews, some also live interviews in there with various people, including Warren Buffett's sister and some shareholders who started going, years ago. Some were kids and now are teenagers. So that was all very interesting. And for us value investors, this is really a key time to focus in on what it means to be a value investor, to hear from the greatest value investor who has ever lived and is still living. And so while we still have him here with us, he is 93 now, it's important to tune in and hear what he has to say, because there's always these little nuggets in the annual meeting question and answer. And this year it was a little less, and it was a little bittersweet because Charlie Munger is no longer there. He did die last year at age 99. So it's just Buffett up there. And so he doesn't have his right-hand man to kind of, throw things off of. Or Munger was always really well known for coming in with a quip on things when Buffett, was kind of rambling or whatnot. So you did miss that. You could tell, and Buffett admitted that he missed having Charlie up there as well. And up on the platform with them was, several other of the Berkshire bigwigs, but it's not the same without Munger. But we still did have Buffett himself up there. And a lot of the questions were very good. I didn't realize, I always did wonder, how do they pick the questions? Obviously, they go around the stadium and you have certain mic numbers, and then whoever's in line there gets to ask their question, apparently. But I didn't realize, people wait outside the arena the night before, and then they literally open the doors and people make a run for it. They make a run for those microphones so that they could get in line to be one of the questions, that's heard. And I think there's some kind of lottery too, or something. You make a run for it. There's some kind of lottery, and then you get your question position at each of the microphones. So some people get real lucky and they manage to get a question several years in a row. And some people just keep trying to get that question to Buffett while they still can. So he covered a large range of topics, and I'm going to talk about some of things that I just scribbled down on my notes as I was watching it, because I thought some of these things were kind of interesting and could be helpful to the rest of us. We're always trying to get these little lessons from Buffett, and he always makes it seem so easy, you just read this book and you'll be fine, right? But I've read that book and it doesn't seem that easy. But yeah, there's just so much you can learn when you're watching these things. So I have six key ideas that I just kind of scribbled down. Some of them won't really help us that much on investing, but were kind of interesting when he went off on some tangents. Other things will help us with investing, I feel. And he just, giving us some just ideas to mull over, just the basics, really. And investing really does not have to be that complicated. Value investing or growth investing. It's just really the basics of choosing to buy good or great companies at a good valuation if you're a value investor, and holding those companies while they grow. So let's dive right in. So there was a lot of discussion about the donation that the widow of one of the big Berkshire shareholders gave to the Albert Einstein College of Medicine. I already did a podcast on this. It was, a couple months ago, it was announced that she was giving $1 billion to the Albert Einstein College of Medicine. And Buffett talked about it at the annual meeting because that's just kind of a great end result of being a Berkshire shareholder. And they had been shareholders since the 1960s, I believe. So one of the long-term shareholders, that's how they got the billion, because that's all the power of compounding. So Berkshire shares have been up big, since their inception, basically. So if you were a shareholder and you managed to hold on all that time, that's where the power of compounding, which Buffett has talked about over and over and over again, really comes into play. Now, for those of us who haven't been investing very long, it's hard to see the power of compounding. It takes even more than 5 years, and I would say even more than 10 years before you really start to see the big, the big difference in the compounding, and you really go, wow, geez, I'm really doing well with this investment. And it's really, for compounding, it really is about time. And the longer you can hold it, the more time you have to compound, the richer you will be. And that is why you don't really see that much of a difference in, 5 years or 7 years or even 10 years, because you need more time for the power of compounding to really hit. So I'm taking a look at the Berkshire Hathaway A shares right now, just to kind of get a handle on. Remember, the A shares were the original shares. They are now priced at $622,745. They've never been split. That nothing has ever happened to them, but they did launch the B shares in order to give the rest of us investors who were not in it originally a chance to get in at a lower price, so that we could buy a share at like $2,000 or whatever it was at. And so that's been helpful at getting a lot of smaller investors a chance to get in there. So why isn't this giving me? It's kind of giving me. I wanted to say it was like some huge number. It was just, it's hard to get it on Yahoo Finance because the company does go like all the way back. So I'm showing 214,000% gain on the A shares. So it's somewhere around that. And even going back to 2003 on the Yahoo chart, it goes back that far. It's showing 740% during that time period. The S&P 500 since, I guess this is right at the end of, since November 2002 on this Yahoo Finance chart I'm looking at. It's up 740% since then through May 2024, and S&P 500 is up 499%. So it is still outperforming the S&P 500. That is always the benchmark that Buffett uses for Berkshire. And that is very impressive return indeed. And like I said, if you were some of these original shareholders, that's where the billions of dollars comes into play because of that huge gain in the stock. So compounding played a big part in this annual meeting because of this donation. He didn't go into any other details or examples, but there have been others over the years that have come forward. And now we're seeing some of these long-term Berkshire shareholders start to do things with this money. So I'm sure we'll hear some more stories as we go along over the next several years. Okay, the second big kind of thing that caught my eye was that he talked about reading Ben Graham's book again. We've talked about that, The Intelligent Investor. Yes, it's over 600 pages. Yes, it's pretty dry. This is the, fifth or sixth edition. I forget which edition is out now. That edition, the latest one, is not so new now. It's like 20 years now, almost 20 years old. I don't know if they're going to update it again. Jason Zweig took it on last time. I don't know if he's going to do it again, but it does need to be updated again because the examples that it gives from around 2005, 2006 time period a lot of them were from the dot-com bubble and that kind of thing. And so we need it updated again, most likely, to reflect everything that's happened in the 20 years since then. But Ben Graham's original book, which was last updated by Ben Graham in the 1970s before he passed away, that one is still embedded in the book. So it'll have a chapter of Ben Graham's, and then it'll have a chapter of Jason Zweig's that's updates and talks about some modern examples about what Ben Graham was addressing in his chapter. So it's a great book and definitely worth reading, but it is pretty dry, I have to admit. So that's why I've done podcasts on various chapters over the years, because it's easier to kind of break it down into chapters. But Buffett said, we all know he read the book and it changed his life. But he said he's read the book 3 or 4 times. And his advice was to read great books several times because you're always getting some new little tidbit, or you just need a refresher because it's been 10 years since you last read it. And so it is always good to read books that you're getting a lot out of multiple times. So that was a key thing he said. And then he brought up books later, but I'm going to get to that in a minute. Then he talked about Paul Getty. He was the richest man in the world in the 1950s and the 1960s. And he actually has a book out too. I think it's called like How to Be Rich. I own that book. I bought it at the Getty Museum out in Los Angeles. And I was going to do a podcast on it. So maybe I will now since Buffett is bringing him up. But maybe Buffett, he talked about how he was reading a book and he was interested in Getty too. And maybe even read that book because the book is pretty old now. Maybe he read Paul Getty's book on How to Be Rich. But maybe Buffett was interested in his younger years in, these other rich men, mostly men, and what they had done. There is a chapter in the book about investing and like how he made the money. So I guess I will do a podcast on it now. But he brought up Paul Getty in the concept of wills because he said he had like 50 codicils to his will. Buffett doesn't like codicils. I guess Munger had some codicils. We found out already. But he talked about how it's interesting to watch people's wills and all the stuff about wills. So that was just kind of an interesting tidbit about Paul Getty, but now it's making me think I will do podcasts on Paul Getty's book. So why not? Then he got a question about AI and, if he was going to look for companies that, are in AI or what kind of impact AI was going to have on the Berkshire companies. I guess that was the question. And he said he didn't know anything about AI. So that's typical Buffett response, right? We got kind of a lot of that when the internet came out all those years ago. And he basically said, I don't know anything about the internet either. But he did say he thinks AI could lead to more leisure time. But he himself liked to have problems to solve. So while it was going to have an impact on society at large, he didn't want to have more leisure time. He likes being active and, thinking about things and doing things. So that was his kind of talk about AI. Then Paul Volcker came up and on discussions about deficits and inflation and things like that. And he said Volcker was amazing and that he had talked at the time in the 1970s when Volcker was, raising rates to try to crush inflation, that Volcker had threats on his life back then. And then he said this, and I put it in quotes, he was the man for that crisis, unquote. And that he just really admired how Paul Volcker took on the crisis, and that there's a lot of good books about him and that we should read books on Paul Volcker. So that's another one to add to my list. I have wanted to read books about Volcker in the 1970s. So now this is impetus for me to be doing that as well. He did get a question about the deficit and whether or not he was worried about it. And he said, no, he's not worried about the deficit. He thinks about it, but he isn't up at night worrying about it. But that's kind of a typical Buffett response as well. But these things do kind of reassure us, right? When we hear, someone like Buffett who's been around many, many cycles and has just seen a lot of things, has the experience talking about how that aspect at least is not keeping him up at night. So those were just a few of the things that I wrote down. But someone also asked about Burlington Northern, the railroad, and he went on to discuss about how they were interested at the time of buying Union Pacific, which I didn't really realize. And he really liked Union Pacific, as I do, and I have always liked it over the years. And instead they ended up with Burlington Northern, and that worked out. And he said something like, we're glad we ended up with BNSF, but Union Pacific is still out there, still publicly traded. And so I thought I'd take a look at some stocks that either Berkshire, maybe they might be interested in buying an equity position in, or are already kind of owned by Berkshire and you can buy an equity position in. So I did want to start off by looking at Union Pacific. It's a Zacks number 3 hold right now. That's not unusual. And most stocks at Zacks are the holds. They are the 3s, which is about 80% of the stocks are the 3s. So not unusual at all. It's trading with a forward P of 21.8. That's around where the railroads have been for quite some time, just a little bit over 20 times. PEG ratio is 2.6. That's not altogether that cheap, really. It does pay a dividend, as it always has, yielding 2.1%. So not that great on the dividend. I actually haven't bought Union Pacific either for the value investor or my own personal portfolio because it always just was a little bit too pricey for me. Even when it's had pullbacks, it just hasn't been all that cheap, certainly not dirt cheap. And so I've just always kind of stayed on the sidelines. But earnings estimates are on the rise. They're supposed to be up 7.6% this year on earnings and 10.7% for 2025. So I'm liking that with the earnings growth. But these are fairly mature companies now. They've been around, I don't know, since 1860s. So Union Pacific. So it's getting up there in the years. And so not surprising that, the revenue growth is a lot slower now. It's just 3% expected for 2024 and 4.7% for 2025. That's why I want to really get it at the cheaper valuations if I can, because it is just a slower growth stock. So I don't want to overpay for it. But Union Pacific, still an interesting stock, and still like those rails. They basically do have a monopoly or a moat, so to speak, on their routes. They own those tracks here in the United States, and nobody's building any new big freight rail tracks. That I've seen. Nobody's really doing that. So what are these shares doing? Let's see. Over the last year, they're up 23%. S&P 500 is up 27. So a little bit of underperformance over the last year. Year to date, it is lagging. It's up just 0.1%, where the S&P 500 is up 10 now. So that's Union Pacific. If you're interested in the rails, check it out. UNP is the ticker there. And recently on StockTwits, someone was talking about SONY and maybe Buffett buying SONY, like outright, I guess, or maybe just shares of it. It has a market cap of 100 billion. I mean, technically they do have the cash on hand if they wanted to go in there, right? But maybe taking an equity position in SONY. It is the type of company that Buffett likes to buy. It's big. It has great free cash flow. It has great management. It's actually, the stock is fairly cheap right now. It dominates its industries, whether or not it's in gaming, cameras. It's on movie studios and television. It's music. It's one of the biggest music publishers in the world. Sony has a lot of the things he likes. So I was kind of dismissed it when we were talking about it on Stock Twits as like, Sony, no, he's not going to buy equity position in that. But then the more I thought about it, I'm like, well, why not? I did used to own it in the value investor portfolio, but we sold out of it in the sell-off in 2022. And the shares have kind of meandered, and we're at multi-year lows before the recent earnings report. It did get a pop on the recent earnings, but year to date, it's still down about 12%. They are doing a big share buyback, and they are splitting the stock. So that's kind of interesting because it is under $100, but they are gonna, I saw that they're gonna split it, I thought, like 5 for 1 or something. But that share buyback and all of that is really the key thing for shareholders. And they want to give more of that free cash flow back to the shareholders, obviously. And so they're targeting 40% total payout by the end of 2027. The fiscal year, it ends in March of that year, 2027. The payout ratio was 32% last year. So it's going to up that payout ratio. And again, this is the type of company that Buffett likes to buy. But it's a Zacks number 4 right now. And I think that was because they just reported earnings. And so it's a foreign company. We have a lot less coverage on it. We only have a couple of estimates. And well, one is lower for this year. But it's only gone down a couple pennies, even though it had a big beat in this quarter, 25% beat. So earnings expected to rise this year, just 5.5%, fiscal 2025, and then fiscal 2026, 16%. So the outlook is looking a little bit better, and almost no revenue growth for fiscal 2025, but 7.6% for 2026. So this is another one where you got to get it cheap. And PE has fallen in this year because the shares are down, and it's now trading at 14 times. So that's pretty cheap for a big company like this that is investing money back into the business. And is also giving it back to shareholders. Now, one thing I do like about Sony on the entertainment side is that they did not start a streaming service. They were one of the few, I guess the only ones, who decided, no, we're not going to launch our own streaming subscription service and put all of our content on it, their movies, their TV, all of that. Instead, we're going to sell it to the other streaming services, including their 20 to 25 movies a year that they make. And we're going to sell it for a lot of money because all the content, other streamers, they need that content. And so they did pay big bucks to get Sony's content. It was genius. So they get the money in without any of the risk of running their own platform, raising the subscription fees, the churn, the this, the that. They can focus just on what movies that they're producing right now. And basically the deal that they got, with Netflix for some of their content pays for them to make the movies. So anything in the movie theaters before it goes to the streaming services was gravy. And so I love that deal. I thought it was super smart. Now, apparently they're in talks to possibly buy Paramount. So we'll see if that goes through, but maybe they only want the content there and they don't want the actual studio. I don't know. That's some of the things I was reading, but we'll see if something happens with that. Paramount does have a lot of good content, and it would fit in well with the Sony catalog. And Sony, again, has done really well with, getting their content out there and making a lot of money off of that old IP. So I like Sony a lot. I used to own it, as I said, in the value investor and in my own personal portfolio, but we did get out of it when it has stumbled a bit. But maybe maybe it's time as a value stock to get back into Sony. So the ticker is now Sony, SONY. They changed it a couple of years ago. It was something else, but it is now Sony. So easy to remember, and you might want to keep it on your watch list. Another one that I talked about in a podcast a couple of months ago now was Alphabet. Remember when I said, should Berkshire Hathaway buy shares of Alphabet because they were a little bit depressed. They were the cheapest or among the cheapest out of the Mag 7, and they still are, even though shares are trading near all-time highs again. PE is at 22, and that's cheap for Alphabet. It has gone down in like 17, 18 in the past, but for a company of this size and what areas it's in, technology, the advertising side, YouTube, talking about streaming, YouTube is now the biggest streaming service in the world. It made $8 billion last quarter for the holiday quarter. That was not a record because the quarter before they did make $9 billion off of YouTube, but it looks like the revenue is staying elevated up there in the $8 to $9 billion range. And it's just a tremendous, YouTube is a tremendous vehicle. So I love the YouTube side of it, but they've got a lot going on with AI now. AI search is apparently going to launch. And so we'll see what happens with all of that. But it has a PEG ratio of just 1.3. And that's pretty low. It's not 1 or under, which indicates value plus the growth. But 1.3, again, for a company of, techie, social media type of company, that is low. So what is earnings looking like? So I used to go on and on 10 years ago about how was Alphabet still doing double-digit earnings and sales growth year after year after year, because it was massive even 10 years ago. Well, it's now more massive, and it's still doing it. So for 2024, sales expected to be up 15% this year. Analysts have 2025 a little bit lighter at 11.5%, but still double digits on top of these huge numbers. So for this year, the Zacks consensus on the sales is looking for 295 billion, and 2025 it's looking for 329. These are just incredible. Earnings side, they've been doing double digits for a long time on the earnings side, and it's even bigger this year. 2024 expected to be up 30%. Alphabet, 30% to $7.57. They made $5.80 last year. 2025, another 14% to $8.63. All the estimates are up 16 higher in the last 30 days since their earnings, basically for both years. So all the analysts are like, yeah, we're being too conservative. We need to raise it here. And they have. But they had another big beat. It was a 40-cent beat for last quarter. So they have been crushing it in the basics, in the fundamentals, and they are Zacks number one ranked strong buy right now. Did I mention Sony was a 4? Yeah, I think I said that. And that's because those earnings estimates are a little bit, different. There's just a lot less coverage. And so if someone is lowering one, we're going to get a little bit worse rank on Sony. But Alphabet, we've got 16 estimate revisions here. And so it's got the big coverage, and they're all in agreement, and they're all raising pretty substantially. It went up to 757 from 678. And that's a lot more than the 40-cent beat there. So analysts bullish on top of the beat for 2024. And that is important as well. So this is a very strong buy. But, people always look at on the tech companies, you can't look at PE, you have to look at price to sales. So I'm looking at it for Alphabet, and it is 6.6. on the price to sales. That is cheaper than many of its peers. As we know, Microsoft and some of the others are trading at double digits. I'm looking at Microsoft right now. Price to sales is now 13. That's very high for Microsoft. And PE there is at 35. So a lot different on these metrics for Microsoft, which is why I always thought, of the last couple of months that Berkshire Hathaway would like a company like Alphabet. It's not as cheap as what it was when he bought Apple. It was at like 9 times forward earnings back then. This is at 22 times. But a lot of the other components of what is going on behind the scenes and with its business is very similar to where Apple was in 2016. So, got to keep this on your list. I own it in my own personal portfolio. I have been thinking about adding some more to that position, and I haven't added for a couple of years for Alphabet, but I just feel like it is an attractive price here. Now, it does have a D for the value style score, but again, some of these other components like the price to book is at 7. So that is a lot higher than a typical classic value stock. So keep that in mind when you're looking at any of these. And remember, value investors can own growth stocks too. It's not forbidden just because you are a value investor to, disregard all value stocks. And some value stocks become growth stocks at a later date, like Apple basically has. It's no longer cheap. And yet, Buffett is still owning it. He did decide to sell a chunk of it last quarter. He said for tax purposes, but it was overpowering the rest of the Berkshire equity portfolio at this point. It was over 50%. So those sales have now brought it down to 40%, which is a little bit less risk to have that much money in one position. So, he cashed in a lot of those big gains. But he still owns Visa and MasterCard. Those are 2 stocks I consider to be pretty pricey. And I'm taking a look at Visa right now. It has a PE of 27 right now. Its price to book is at 13. Price to sales is 14. None of this is cheap. This is even more expensive than Alphabet, but he's holding on to it. They haven't added to that position, but they haven't sold out of it. It is a very small position, both MasterCard and Visa, but he's always liked these kind of financial stocks, and they've owned it, I think, well over a decade. And that has been a great performer for them all that time. Visa, the earnings expected to be up 13% this fiscal year. They're on the fiscal calendar, and 11% fiscal 2025, still growing revenue 9.8%, and next year 10.3%. So this is another one. It might have been a value when he bought in all those years ago, but now it is a growth stock here. So I like Visa and MasterCard, but a little pricey for me on some of the metrics. I always keep waiting, for them to pull back, and these have pulled back, and earnings continue to rise. So that was a good combination in 2022. You could have gotten in a lot cheaper on both of these names, but these are ones that are just staples of Berkshire's portfolio at this point. He doesn't really talk about them, but they are very small percentage compared to, Apple and even like Chevron and some of those names. So those are just a few stock ideas if you're thinking about, kind of going the Buffett way. And what kind of companies he maybe could be adding to Berkshire's portfolio with the $180 billion in cash they now have, and which he admitted will be at least $200 billion at the end of the second quarter. At this rate, I don't know. We're going to be at like $250 billion by the end of the year or something crazy like that. But, those of us who have some extra cash sitting around, these are some great options out there to be investing in right now in these kind of big cap companies that have moats, that have strong brands in their industries, and have some interesting earnings going on with all of these. So let me recap the stocks again. So there's Alphabet, GOOGL is the ticker I use. I do own it in my own personal portfolio. There's SONY, SONY. There's Union Pacific, UNP. I talked about Visa. It's just ticker V. And it's also, on a little tidbit, the only S&P 500 company that has never missed on earnings. I say that every quarter and people are like, you're going to taint it. But I've said it for years. So apparently that's not working and I haven't tainted it yet because they continue to be, it truly is an amazing earnings surprise record. I don't know if there's some kind of award they could be given. They should be given one because it is just tremendous. And MasterCard, ticker MA, they also have a tremendous record, but they did have at least one miss in there. Actually, maybe even two now. Let me look because I'm curious. But yeah, they had one in 2020 for MasterCard. I don't know if that spoiled the whole thing. I want to say they had one a couple of years before too. I'm scrolling back on Zacks.com. If you're on the earnings surprise chart, you can actually scroll back a lot of years. The data keeps going back. There's like a little arrow. Oh, yes, I did remember correct. They did prior miss in 2014 as well. But still, I mean, two misses in that whole time period in over a decade, that's incredible as well. So both of these earnings all-stars. So, keep that in mind too, if you're looking for something that's really steady Eddie and really great at getting out to the analysts what is happening with the business, because that's what it's all about. If you're beating every quarter for a decade. So, MasterCard MA, and we'll be back, with more talk on value stocks, obviously next week, because there's a lot going on. There's a rally going on again in the stock market. We're back to all-time highs in the S&P 500 and the NASDAQ, but that doesn't mean there isn't value out there. You know where it's at, but it's in some hot stocks right now. A lot of banks are starting to move again, and home builders, of course, but they remain cheap. And, energy is kind of stalled, but it remains cheap as well. Those are the three big areas. Utilities, also some value in some of the utilities, and maybe even in some other commodities types plays. Maybe we should be talking about gold soon here on the Value Investor, maybe some gold miners. But you want to be sure to subscribe so you get all the episodes. You can get us on YouTube, get us on Zach's podcast. Just put that into the search bar. You'll find it on YouTube. That's only the audio version of the Value Investor podcast. And you can also get us on Apple. We're on Netflix. We're on Spotify. We're anywhere you could get podcasts. But get us somewhere, and I'll see you again next time with some more value stocks.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.